Chapter 25, we talk about other assurance services. So not necessarily the audit. So obviously our primary focus in this book was auditing, but there are other services that the CPA firms will provide for clients. And those, you do have to understand some of those, and some of those are actually on your CPA exam if you So we have review, compilation, and preparation services. So our statements on standards for accounting and review services, SSARS. So many non-public companies, so public companies have to have that audit. But a non-public company, so a private company or a family-owned company, just something that's smaller and not publicly traded, they can choose to have their financial statements either reviewed by a CPA firm, compiled by the CPA firm, or actually prepared by the CPA firm. So again, depending on their level. So the assurance in such engagement is much lower than an audit because again, it's not going through the SEC. Individual investors aren't relying on these statements. Maybe they're going to be reviewed for a bank loan or for something in particular. So it's not as the external users aren't as broad as an audit. So again, it doesn't have to be as high a level of assurance. There's not going to be as much evidence, sometimes if any evidence gathered. And then the written letter of engagement needs to list out specifically what services the auditor is or the accounting firm is actually conducting. So preparation services, that's when the CPA is actually engaged to prepare those financial statements. So they're not going to provide any assurance on it and they're not going to issue any report because they're actually the ones preparing them. So say it's a family-owned business and they bring all their accounting records to that CPA, and then that CPA puts together the income statement and the balance sheet and the cash flow statement for them. So again, they can't then audit their own work or review their own work. They're the ones who actually did it. A review services, that is when the client are going to prepare their financial statements and they're going to present them to be reviewed by the CPA firm. So the types of procedures that would be done in a review are primarily just inquiries of the client's management and then analytical procedures. So looking at the numbers, maybe running ratios, doing some percent changes and kind of see what some of if there's any key issues to look into. So the CPA that is doing this needs to have knowledge of the industry and of the client and their business, and then be willing, obviously, to make inquiries of the client's management. They'll perform analytical procedures, reviewing those financial statements. A lot of that normally goes hand in hand. And then they may reconcile any underlying accounting records. So again, probably not all of the accounts, but maybe some of the major accounts, they could ask for the reconciliations to see that like what's in their accounts receivable, go back to an aging statement or something along those lines. They will obtain a letter of representation and then they'll prepare a document at the end. So the first paragraph is going to outline what time period was covered and that they were reviewing the financial statements. They'll mention that the management is responsible for those financial statements and the accountant is responsible for reviewing them only. And then the accountant will give a conclusion. So if they fail to follow accounting standards, then the report must be modified. But again, if they're following accounting standards and everything is fine, they would issue an unmodified report, but they would issue that everything is in compliance for the review. And again, a lot of times those reviews go to like banks for bank loans. The compilation services is when the engagement is for the accountant to apply their accounting expertise to assist management in preparation of those financial statements. So the requirements, a lot of them are the same as the review. They have to there has to be an engagement letter listing out what their specific duties are. They should possess knowledge of the industry, knowledge of the client and their business. They should be able to make inquiries into management. and then review the compiled financial statements and correct any information as needed. So prepare documentation and then request that management revise those statements as needed. So it's almost more like the management provides the financial statements, but the auditors are going to go through them and make recommendations and kind of double check stuff and have those financial statements kind of cleaned up. So, and again, they would not be independent though. So they, because they're going to be actually within those financial statements, and kind of telling what journal entries maybe need to be made to correct it, those types of things. Then we also have CPA firms that are reviewing public companies for their interim financial statements. So if you're a major publicly held company, you normally do have the auditors come every quarter. And every quarter, they don't obviously conduct an audit, but they look at your 10Q. So your 10Q is a quarterly financial report that's filed with the Securities and Exchange Commission for all publicly traded companies. It's a lot smaller than the 10K, but the auditors will come and review over those numbers and maybe make some inquiries and do some analytical procedures. So here it says again, it's like a review, and that they should have knowledge of the accounting procedures in the industry, client's business, make some general inquiries, perform analytical procedures, and have a letter of representation. It's unlike a review in that the auditor must obtain sufficient information on the internal control procedures. They must read the minutes of the board of directors meetings and then compare financial information to general ledger accounting records. So they're going into so when we're doing a review, they never look at the internal control procedures or read the minutes of the board of directors meetings. They don't go into that much detail. So with an interim review of the 10K, they are going to go into a little more detail to feel comfortable. Again, it goes back to who the users of a 10K are also going to be financial investors. Anyone out there could access a 10K or a 10Q and make a decision. Attestation engagements is the purpose to provide an opinion or a conclusion of their findings to specific users. So these are going to be a little bit different in that it's going to be to a specific agency. So we have the statements on standards for attestation engagements. And again, the practitioners or the CPAs are responsible to have appropriate competence, comply with ethical requirements, and maintain professional skepticism. So the type of engagements could be an examination where they reach a positive conclusion. They could do a review where there's a negative assurance conclusion. And then they're going to have agreed upon procedures. Let me see if I get into. So when we talk about, let me get to that page in the textbook if I can find it to give you just a little bit more detail. So a positive conclusion is expressed by the CPA in the form of an opinion. And in this report, the CPA makes a direct statement about whether the presentation of the assertions conform with applicable criteria in all material respects. And then they give you an example of that. Then where there's a negative assurance conclusion, the CPA's report states whether any information came to their attention which would indicate that these assertions are not presented in all material respects. So the one is more of saying, yes, everything looks great. The other one is saying, I don't see anything that would be material. You know what I mean? I didn't uncover anything. So it's, so they say that the information indicates that the assertions are not presented in all material respects in conformity with the applicable data. And then it goes on to say, Review engagements are prohibited for most services where specified attestation standards have been issued. So I think it's going to be more of a unique or not as stringent of an area that's going to use these negative assurance conclusions. And then our agreed upon procedures are all the procedures that a CPA will perform are agreed upon, and the responsibility of the party making the assertions and the specific people who are the intended users of the CPA's report. So hopefully that gives you a little more detail. Okay, then we have reports on controls at service organizations. So those can be two different types. So type 1, it's dealing with the internal control over the financial reporting system. So type 1 is going to talk about the design of the internal control. Type 2 is going to talk about the design as well as the effectiveness of the internal control. And then there can be reports on controls at a service organization, and those are going to be relevant to security, availability, processing integrity, confidentiality, or privacy. So a lot of these are dealing with like the IT functions, because again, in today's world, everything is so computerized, and you got payments and money coming in and out electronically. You have all your invoices being processed electronically. Whoops. So we want to make sure that all of those controls at that organization are in place so that the data is secure. There's processing integrity, so we can trust that the accounting records that are coming out after we input all this data are accurate. All of the account information and the all of our customers' information and all that stuff is confidential and private. And then we have trust service reports for service organizations. So this is more of a general use one, but it's similar in that this security, availability, processing integrity, confidentiality, and privacy. Then there's also the preparation of prospective financial statements. So prospective financial statements are like forecasted financial statements. So it could be forecasted where we're saying, whoops, keep doing that. We look at our current financials and say, okay, where do we expect to be next year? So it could just be like we expect sales to go up by 3% or whatever, and then we project that out. A lot of times then it's, you got to look at your expenses to say, are those going to be a set percentage of sales, or are they more fixed in nature? The variable expenses are going to go up as sales go up. Our fixed expenses are going to kind of stay where they are. The projection could be if there's a hypothetical assumption. So say you said, we are going to acquire another company, and now we're going to give projected financial statements of us merged with this other company. Or maybe you're going to say we're going to divest of a company. So what is our projections if we no longer have this company in our financial statements? So we would have to do that. In the oil and gas company, we had a lot of mergers and acquisitions. So we would be involved in making these projections and these forecasts when there was a merger or an acquisition. So you're almost like saying, well, let's pretend we would actually even have to go back. So like we would take their financials and our financials and combine them and go back 2 years and say, if this merger had happened 2 years ago, this is what these financials would look like. And then we project now that we come together, this is what they will look like in the future. So we would have to do a lot of different prospective financial statements during those mergers and acquisitions. So then the use of them from a general standpoint, it could be any third-party users. So say it's a bond prospective or something that's going out into our investing community, where any interested investor could have they could get their hands on it. I'm struggling with the right word, but they could see those prospective financial statements and make a decision accordingly to invest in a bond or to invest in the stock or whatever. If it's limited, then it's to a specific person. So, like maybe they're getting a bank loan. Maybe they're even getting the bank loan to acquire this new company. So then they're going to put together these forecasts and projections to say, hey, look how successful we'll be if we can raise the money to buy this business. So then it's going to be specific to that bank or that group of banks who are going to loan them the money. The CPA, the type of engagement, the CPA obtains satisfaction as to the completeness and reasonableness of any assumptions that are used in the financial statements. And then the examination of these prospective financials, the CPA is going to evaluate the preparation, support, and presentation of the prospective statements and then issue an examination report. So again, they're going to look at these statements that are prepared by the client, make sure that it looks accurate and everything's in there and that they understand and can, sign off on these statements. Then some other engagements, you could have agreed upon procedures engagements where it's a third party user that is specifically asking for something to be audited. So, maybe they are it has something to do with a taxing authority, and the taxing authority wants to make sure they're following all these proper protocols. Or maybe it's like a compliance agency, and we want to make sure that they're in compliance with whatever. So it's going to be a third party who's making the request and outline what they are wanting to be done. Then we can have other comprehensive basis of accounting. So that could be like, it's non-GAAP. So maybe like cash basis, income tax basis, a contractual basis. So something other than GAAP, and we're testing that that the accounting records are within accordance with whatever basis we're looking at. Specified elements that maybe we are testing into, such as royalties or income tax or sales. So that makes me think like at the oil and gas company, and I don't know that we ever actually had an audit of our royalties, but we had a whole department in our accounting department in oil and gas. We had a whole department called revenue, our revenue department, and that's all they worked with was royalties. So they would look at these wells that we were producing and drilling and getting natural gas from, and figuring out who are the interest owners in these wells and what does the contract say, like what type of a percent do they get, and then we would cut them a check every month. So it was again, when you're talking, you have thousands of wells, and then wells can have, like, there could be a well in an allotment that every owner in that allotment shares, so that if that person sells their house, it switches ownership. There was a lot to that. So say if we were being, say if somebody came back and said, hey, I don't think you paid us right, they could then get an audit firm to come in and review all of that detail and make sure that we were paying them correctly. So something like that, it's more like a detail audit of something specific. And then this is also one that normally the auditors will do, at least for us at the oil and gas company. They did it every time they audited us. So they looked at, because we had a large, what we called a credit facility, where like 4 banks came together and loaned us a large amount of money. So then every year the auditors would have to review that we were in compliance with those debt covenant agreements. So that was part of the audit procedure, to verify that we were. If we were not in compliance, per that debt covenant agreement, they could call in that loan that day. So it was a big deal to make sure you were in compliance. So those are, again, just some kind of different things that auditors can be called in to do.